Looking to add to the biggest weekly gain of the year so far. From New York City this morning, good morning, good morning. Your equity market up 0.2%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open with Jonathan Ferro.
From New York, we begin with the big issue, the beginning of the end of easy money.
We definitely have a new regime underway.
We're at a turning point.
There should be no ambiguity.
Monetary policy is tightening.
The environment is one of tightening policy.
End of QE, beginning of QT.
We've largely priced in a more aggressive Fed.
They confirmed that tapering would end on schedule in March.
We're talking about 5 and 6 and 7 hikes.
All the talk around 50 basis points. The Fed is further and further behind, and they're going to have to catch up.
They do have a really difficult job.
As the Fed and global central banks pull back,
that's going to cause some challenges,
particularly as it relates to the bond market.
It's time for investors really to get used to this.
Joining us now is G Squared's Victoria Greene, Tallbacken's Michael Purves, and Collin and Charles Schwab. I want to start with you, Victoria. Just how much of a regime shift is this?
Not an unexpected regime shift, and it's quite a normalization, and it's a good thing. This means the economy is going forward. I do think it's interesting now we have a 35% hike of a 50 basis point hike here in March. So obviously people are accelerating, but I really don't think it can get much more hawkish, right? I mean, we're already at 5 to 7 hikes, maybe 50 bips in March, you know, completely starting to unwind the balance sheet. I think all of that started to get priced in. And so while the Fed is definitely moving a little late, they are going to move, but the market's already pricing in an aggressive hawkish move. So I don't think it's the end of the world. Regime shifts normal. This is just part of the recovery and economic cycle. And, you know, as a person who's bullish on equities, I say bring it on.
Andrew Sheets of Morgan Stanley did not say the same thing over the weekend. He said it begins. He wrote this: from May 22 to May 23, Morgan Stanley economists expect G4 central bank balance sheets to shrink by $2 trillion, 4 times the largest 12-month decline ever from 2018 to 2019. Michael Purves, do you agree with Victoria Greene? Bring it on.
I do agree with Victoria. I think for me, you know, so far, the 10-year yield has been pretty range bound, and all the violence has really been, you know, in the next couple of years. I think what will be, not friendly for equities and certainly not for the back end of the market is if a meaningful term premium is really built in. And I think that really gets to, you know, how the markets and also the Fed consider sort of longer term inflation. And to me, that's the big riddle I'm trying to work out. Whether we get, you know, 50 in March or 25 in March and all that, to me, from an equity perspective, I think that's more noise. I think it really comes down to what is the long-term neutral rate, where is that perceived to be settling out, and I think that's going to be a very interesting thing, and what factors are needed to take that those expectations meaningfully higher.
Yeah, the start of the journey is old news. Now it's about the destination. So let's talk about that more. Bank of America say this about the ECB. They're calling for accelerated tapering with QE ending in July, rate hikes in September and December. They say the Hawks have won. January inflation lifts our 22 forecast to 4.4%, but 23 stays below 2. They say when fundamentals aren't there, hikes can't go far. Collin Martin, can I get your view on this? This is a conversation about the start. Let's talk about the destination, how far the Fed can go, how far the ECB can take things.
That's the big question that we're looking at, John. From the Fed standpoint, unfortunately, the markets don't believe they can get too far. If you look at expectations for the terminal rate, where we look at the Fed funds rate or Eurodollars futures a few years out, they're still stuck in that 2 to 2.25% range. And unfortunately, we didn't even really see much of a rise over the past few weeks, despite still high inflation and despite such a strong jobs report on Friday. There are some good news out there, though. You know, one thing that we're looking at is the participation rate. We saw a good jump both in the broad index and in the prime age population participation rate on Friday. That means there is more of a runway for the economy to continue to grow, for workers to rejoin the workforce, might reduce some of the pressure on wage prices we're seeing, and that will allow the Fed to maybe hike more than the markets are anticipating. We're not, changing our tune just yet. For now, it looks like they might only be able to get to that 2.25% range, but it comes down to a balancing act. If they can successfully hike rates without, popping any sort of asset class price appreciation that's out there, without disrupting the markets too much, if they can do it in a somewhat methodical way, in a somewhat patient approach, and they can maybe get above that 2.25% range, which can lift all yields a little bit higher.
Let's just sit on that graphic that we just put up on the screen of the estimates for Thursday for CPI in America. 7.3 is the median, 7 is the low, the high is 7.6. And let's bring in Michael McKee. Mike McKee, this whole street expects a 7 handle this Thursday.
Oh, we expect a little bit more than that. And maybe we get the same thing in February. But then economists think we're going to start to go down because of base effects. But here's what we're expecting Thursday, at least the medians for what we're expecting. And it is, as you say, 7.3% for the headline. For the core, it is 5.9%. And we continue to make those 1980s numbers over again. Where does it matter? Well, it does matter down in Washington. It does matter to Joe Biden and the administration. Bloomberg, a story today about how they're retooling their economic message, because what's happening is people's wages are not rising as fast as inflation, and we will get that data on Thursday as well. The inflation adjusted wage levels, as you can see, below zero, down about 2%, and that will take a bigger hit on Thursday when we get numbers like 7.3%. So there's a political implication, but so far it is not feeding over into the economic implication. A lot of lines on this chart, but basically there are 3 break-evens, 2-year, 5-year, and 10-year for investors, and there's 2 for consumers, the 1-year and 10-year Michigan numbers. And as you can see, inflation has continued to go up, but except for 1-year inflation expectations by consumers, expectations stay anchored. So the Fed isn't going to be thinking it needs to do a huge whole lot yet at this point. So we'll see what the market reaction is on Thursday. But if we don't see those numbers, those lines start to go higher, then the Fed probably stays on course for 25 basis points and a couple, maybe 4 or 5 rate increases this year if inflation doesn't start to go back down.
Mike McKee, thank you. Still trying to game this out, trying to game it all out. Victoria Greene, I want to come to you on small caps. Where small caps fit into the conversation for you, given this broader debate about inflation?
Yeah, and small caps have taken a beating here in January and February. They're down about as much as the Russell, the NASDAQ. They're down about 10%. I think small caps have a lot of potential because they have a potentially faster growth rate. So as we think that maybe large caps may moderate and slow growth, which quite frankly, earnings have been fantastic across the board. You've seen solid EPS beats, solid margin beats. People are printing money here in these companies. We think small caps may be an area that's undervalued. They've certainly taken a beating the last 90 days. And I think that's an area that if we think the economy might be slowing down and we want to be looking for areas with better growth potential, small caps are certainly an area you could look at that might be able to pick up that growth. But these companies are still companies we hope have good earnings. We're not buying the future earnings, the non-cash flow companies. We still like good companies, just maybe at a lower multiple and a little bit higher upside.
Michael Purves just got this note from Bank of America. Ethan and Savita will be holding a strategy call at the top of the next hour. Just a line from them, a snippet. The key risk to stocks from a Fed hiking cycle, the Fed's hiking into an overvalued market. It ended poorly at 99. Why is it different this time around? Michael Purves, what's your reaction to that?
Well, John, I think, when we came into this year, you saw the NASDAQ, the NDX, really lead this sort of volatility in the market dip lower. There was good reasons for that, which is that you had very high P expansion in large cap tech into a rate move, right? I mean, you can have P expansion and you can have a rate move, but for the NASDAQ, which has a very understandable rate sensitivity, you sort of can't have both. And so what happened during January, it was there sort of a recognition that the equity risk premium for the NASDAQ was overly compressed and it needed to reset. there. So look, I think for me, it's a little bit more nuanced. I think as we look at equities, to me, I look at, I try to get some sense for where the 10-year is likely to trade, and I try to get some sense of what equity risk premium should be layered on top of that to arrive at what is a fair valuation.
Yeah.
So I think by no stretch do I think the NASDAQ is in a super bearish position. I do think it's got some more work to cut out in terms of sort of reaffirming what we just learned, that big cap tech is continuing to generate earnings. But for the broader market and the more cyclical parts of the equity complex, I think you're going to continue to see very good, to Victoria's point, very good, robust earnings growth here that's going to reinforce a very healthy equity risk premium and allow dips to continue to be bought.
I need a better sense of what's happening in the corporate credit market, Collin Martin. When you look at the equity market, it's clear that things have calmed down a bit. Look at the direction of the VIX and volatility. You can get a decent sense of that. Collin, I don't see the same thing in credit. I've heard from a lot of people who are talking about that. Just the cost of protecting losses, what's happening with CDS in Europe and in the United States as well. There seems to be a little bit of a gap emerging here, Collin, between what's happening in corporate credit and what's happening in equities. And I'm wondering how that gap is going to reconcile.
We are seeing that gap. We're seeing credit spreads rise pretty much everywhere, whether it's investment grade or high yield. We're seeing the cost of borrowing increase. We're seeing corporate bonds, any credit rating down pretty sharply for the year. That's what happens when the Fed begins to pull back its easy monetary policies, and that's what happens when the tide rolls out. We expect more volatility. The cost of borrowing goes up. We're not necessarily ringing the alarm bells just yet. We do think volatility will remain elevated in the credit markets this year, especially the junk markets, but we're not expecting necessarily a surge in spreads. But when you look at some of the recent price action and spread action, high yield spreads and yields, the yield was below 4% in the middle of last year, but you can get close to 3% on an investment grade corporate bond index today. So you can get similar yield without taking as much risk. But at some point, as high yield spreads rise and that yield rises, we think there'll be demand there. The average yield of the high yield index is around 5.5% right now. If it keeps rising a little bit, say 6.5%, there should be demand there because fundamentals are relatively strong. Corporate profits are at record highs. Corporations have a lot of liquid assets on their balance sheet. And again, if those yields do rise a little bit, we think there would be some demand there. So we expect more volatility. We do have more of a cautious tilt out there on the riskier parts of the market, but we're not saying investors need to get out just yet.
Collin, stick with us alongside Michael Purves and Victoria Greene. Your equity market's positive 0.2 on the S&P with some movers going into the opening bell. Here's Abby.
John, well, it is Monday, and we do have some Monday M&A action. Starting out with the shares of Peloton, it is possible takeover action that has these shares absolutely soaring. Earlier, up more than 30%, now up 27%, not so shabby. On the news that the company is open to takeover activity. According to confidential sources, private sources, they are working with an advisor. Now, there is a 12% short interest on this stock, so it could be a bit of a short squeeze. But considering that the stock is down about 85% from its peak, 20% below its 2019 IPO price, you can bet that longs are probably pretty happy about this news, too. Spirit Airlines up 12% on the news that Frontier is buying them for $2.9 billion in a cash and stock deal. Plus, they reported a much narrower loss than expected. For Frontier, this is to beef up their services versus the big carriers. Some big movers on this Monday, John.
Abby, thank you. As always, thank you very much. Abby, through the show, breaking down some of the stock movers for us. Coming up, Western leaders continuing their push to prevent aggression against Ukraine.
Now we are not alone, and we think that this year we can combat all possible situations.
That conversation coming up next.
There's a real danger for a Russian invasion, but that makes it even more important to also look for a political way forward.
Diplomatic efforts heating up, hoping to de-escalate the tensions surrounding Ukraine. German leader Olaf Scholz meeting President Biden in D.C. as France heads to Russia in hopes of finding a middle ground. A Kremlin spokesman saying the following. Macron has told Putin he's coming with certain ideas for possible ways to reduce tensions in Europe. Russia has repeatedly, publicly denied any plan to attack Ukraine. Bloomberg's AMH and Maria Tadeo joins us now for more. AMH, let's begin with you. An important conversation a little bit later with the president and the German leader.
Certainly important. And John, we have already seen the diplomacy between Berlin and Washington take hold, especially when it comes to a harsh sanctions package. The most revealing comment for me so far in this whole crisis of trying to get this sanctions package over the line between the Western allies was from Olaf Scholz a few weeks ago. And he said we need to be prudent and no one should be under any guise that these sanctions we're going to put on Russia will not hurt us. And it's really, for me, Jonathan, going to come down, I imagine, to Nord Stream 2, because that is a political hot potato between Republicans and Democrats right here in Washington, D.C. And over the weekend, Jake Sullivan, the president's national security advisor, directly said if there was a further invasion of Ukraine from Russia, there would be no longer a movement towards operating Nord Stream 2. When you ask Olaf Scholz that same question, he just says all options are on the table.
Chancellor Scholz has got to tell us today what he stands for. This is a big moment for him. Mr. Macron, President Macron heads to Moscow. Maria, what's on the table for him?
Well, Emmanuel Macron always has many ideas, and the same goes for French diplomacy. But the question is, how much can they turn into reality? Now, going into this trip in Moscow, Emmanuel Macron said, of course, that Russia is, quote, a great nation. Its people are great people. But, of course, the security of Europe cannot be sacrificed for Vladimir Putin. Now, the question here is, what can he actually tell Vladimir Putin that we've not heard before and can actually lead to a de-escalation? Just to give you some color, though, we know that in this meeting room, it will be just the French president, Vladimir Putin, and their translators. That makes officials nervous in Brussels. It also makes them nervous in D.C. Sometimes we know that Emmanuel Macron has this capacity to go off script, to go off remarks that were not planned. But I do have to say the French have been on the phone with virtually every leader of the Western world, including Prime Minister Boris Johnson and President Biden. The idea here is that he wants to send a united message, but I'd be very keen to find out what happens in this meeting after the two meet in private. Again, it's just the two of them and their translators. And of course, to see that reaction from the Kremlin, which, by the way, they're already saying we're not really expecting a breakthrough, because the reality is, Jonathan, the only bilateral relationship the Russians care about is the United States. They have the money, they have the weapons.
Looking forward to the coverage from both of you. Maria Tadeo out of Brussels, and to the birthday girl outside of the White House, Anne-Marie Horden. I'm not going to let it go, Anne-Marie. Just so many happy birthdays. And we're going to see you again later this hour. AMH, thank you. I believe they've killed your mic, so you can't get back at me either. The team over at UBS warning investors about overlooking conflict risk. They say the following: little or no Russia-Ukraine risk appears to be priced in. If the situation gets bad, be prepared to reduce risk. Let me come to you on that, Victoria Greene. I have no idea what any of this really means. When you say it's not priced in, where should it be priced in?
I don't think it should be priced in. If you look back at a history of conflicts and how the market has reacted to it, anything from World War II to 9/11, historically it's a pullback. It can be aggressive, but then it snaps back fairly quickly. And I look at this more as a saber rattling and aggression, and Putin kind of throwing his weight around. I do understand, obviously, coming this way during the winter, natural gas and some of their commodities are what they're going to push around. And that does have a big effect on Europe. It'd be very hard for us to pick up, even with you've got your Cheniers and your Sabine Pass, and we're exporting LNG. Gas has Europe by the throat, and that's a difficult place to be in. And that's one of the levers he's going to pull to try to get his way. But historically, I've always invested to what is probable, not what is possible. And so there's a range of possibilities here, from full-blown invasion to just saber rattling to cyber warfare and skirmishes, but not a real huge shooting war. And so I think what is highly probable is that this gets resolved without this devolving into World War III. And so in that regards, I look at the market and say, I don't think it really needs to price in much more, because I don't think it's going to be this massive years-long effect.
Michael Purves, your thoughts on this? If there's a risk here, where should it be priced?
Well, it's a very interesting question, and I hear what Victoria's saying, that you need to focus on the probable. Still, if you want to hedge the possible, do you want to buy S&P puts, or do you want to buy get long in oil or natural gas proxy? I would be inclined towards the latter here, because I think Victoria's right. The U.S. equity complex has an amazing ability to be sort of see through this. If you remember back when Crimea was when Putin was moving into Crimea a few years ago, the VIX went from 14 to 15 for about a day or so. Now, this is a different situation. If we do go if God forbid we do go into a hot situation in Ukraine, it will be very interesting. But again, I think the more obvious thing to do would be to get something where oil or natural gas or even food prices are then really you see some jump there. I think it's just better risk return. One other comment I just make on it, which is that again, to Victoria's point on markets seeing through geopolitical tensions, if you look at Taiwan and China, and really over the last 6 months, if you look at Korean won balls, those have been incredibly low, sort of ignoring that whole thing. It's been an interesting discussion for people that focus on geopolitics, but from a sort of cross-asset markets point of view, you're really not seeing tension being built into that situation either.
And Collin, just a final word from you, please.
I'd agree with both of the guests. If you look at just the bond market, there's really very little sense that the markets are reacting to anything overseas with the Russia-Ukraine situation. If you look at the treasury market or the credit markets, it's driven almost exclusively by the U.S. economic data and what that means for Fed policy. Now, if something were to happen where there was a bigger event and the situation deteriorated a little bit, I wouldn't be surprised if we saw long-term treasury yields come down a little bit, if there was a risk-off environment, a little bit of a flight for safety. But at the end of the day, I think Fed policy, domestic economic fundamentals are really what's going to be driving the market right now. And I think the Fed is likely to raise rates in March. It's likely to steadily increase rates for the remainder of the year. Yeah. And I think there's very little that would prevent that from happening.
Collin Martin sticking with us alongside Michael Purves and Victoria Greene. Coming up in the morning calls and later, some of the biggest single name stock market cap swings we've ever seen. More on that next. This is Bloomberg. Messy morning in the European debt market. In the US equity market so far, things are okay. Futures settled down, up a little more than 1/10% on the S&P, up 0.2 on the Nasdaq. That's the equity price action a few minutes away from the opening bell. Here are your morning calls. First up, Bank of America downgrading Southern Company to neutral, seeing a more balanced risk-reward following the stock's recent outperformance. We're down there 1.7%. Argus upgrading Hershey to a buy, highlighting management's focus on shareholder returns and dividend payments. That stock is up 1%. Citi downgrading Stanley Black & Decker to a sell from a buy, seeing rising risk for the company's upcoming earnings. We're negative there 3%. They are your morning calls. Coming up, strategists divided on Wall Street. JP Morgan making the case for stocks as Morgan Stanley wants a further downside. Your equity market's doing okay, positive on the S&P going into the opening bell. From New York, your cash open is next. A global synchronized tightening cycle might be upon us. We've got to figure that out, what it means for this equity market. For last week, the biggest weekly gain on the S&P of the year so far. We add to it just a little bit, up 6 points on the S&P, up a little more than 1/10%. On the Nasdaq, up a little more than 1/10% going into your opening bell. That is your opening bell. Switch up the board and get to the bond market. Two-year yields through 130 over the last couple of days, through 190 on 10s. That sticks. 192, 191, 95 on 10s, up a single basis point. In Italy, at the front end on a 2-year, 50 basis points higher in 6 sessions. We've got to talk about that through the morning right here on Bloomberg TV. I know Guy Johnson laser focused on it. Euro dollar 114.26 with negative 0.2% on that currency pair. Just bear in mind this, even the most hawkish policymaker on the governing council right now is only thinking about a 25 basis point hike in Q4 and another one in spring. Things can change, but that's where the likes of Klaus Knott is right now. Crude at 91.50, negative 0.9%. We pull back on WTI and on Brent as well. We caught up with RBC's Laurie Calvasina a little bit earlier this morning, weighing in on the results so far this earnings season.
It seems to me like it's going to be a messy quarter. Now, we haven't really seen companies, sit here and say things are a disaster, right? Like if you look at the consumer in particular, people are being vigilant. They're watching the low end. But I would say that the confidence level does seem to me a little bit shakier than what we've seen, sort of the past few quarters.
Back with us, Victoria Greene, Michael Purves, Collin Martin. Victoria, where's the confidence come from going into an earnings print where a mega cap can move 20% either way off the back of it? Where do you get the confidence from that?
I think you have to have confidence in your underlying companies. Last year, a rising tide lifted all boats, right? You could almost like throw a dart at the dartboard and companies were making money. This year, it's going to matter who your management team is, what the cash flows is, how they've managed labor and inflationary costs. And so I think this is a good year to be active, a little less into passive indexes, because I think it's going to really matter what you own. You know, if you look at the dichotomy of just automakers, and I know it's not apple to apples, but what Tesla did versus what Ford did, or what, you know, Snap did versus and Twitter did versus what Facebook did, instead of being able to say all auto companies or all social media companies, you're having to actually look around and say, okay, who is the best run company here? Who has the best growth prospects? Who's managing during an inflationary period better? Because the chip shortage didn't hit everybody equally. The labor inflation costs didn't hit everybody equally. And so you have better companies managing this crisis and managing through a different cycle. And so I think it really, really matters. And I'm not surprised. It's kind of nice to see it where the fangs of the world just outperform everybody. It is going to matter which ones you own. And you know, obviously Google and Amazon and Apple, they were absolutely stellar. I mean, it's hard to bet against them, but at the same point, you had your reminders with Netflix and Facebook. You got to watch those valuations and you got to feel comfortable in the company's growth prospects going forward. I think it's funny because it no longer matters. What did you do for me last year? All we care about is what are you going to do for me now?
And next year and the year after. Michael Purves, to Victoria's point, it's not just about sectors versus sectors within sectors. Massive winners, massive losers. A lot of people come in to any given year and say the same thing. Mike, they'll say it's the year of stock picking, the world of active management. Things have moved on from passive. We're saying it again, Michael, but is this time different?
Look, I think there is, you know, as we're getting further into this cycle, there will be, you know, a lot more nuances there. You know, on Facebook, I do kind of wonder whether that massive miss, you know, Facebook bears have been waiting for that for 3 or 4 years now, right? I mean, there's been, you know, it finally seems to have caught up with it. And I don't know if I don't think it's in any respect you know, some sort of indication of any economic condition. I would make one other point here, which is that, you know, in terms of the broader issue of do you want to allocate to equities in the United States this year or not, it's important to recognize that at least so far, we're a little more than halfway through the earnings season. And certainly a lot of the most prominent names have come. And the revenue beats are more impressive than they were in Q3. And Q3 revenue beats were really quite impressive as well. Earning beats are also quite robust, not quite as robust as the revenue beats. So I think there's, you know, it does sort of, I think, reinforce this notion that we're looking at very robust nominal GDP this year. And obviously, you know, stock picking is important, but I think there's you know, to think that, you know, we're not going to continue to see at the index level very impressive earnings growth this year, even with some margin compression in certain stocks and sectors. I think that's going to be, you know, that's a hard bet to make. I think I'm very constructive on earnings this year and into next year. And I think it's also important to recognize that some of these supply chain issues, you know, as it relates to companies like Ford and so forth, they really do also help reinforce sort of a higher floor of earnings over the next two to 3 years as well.
There's a ton of way of viewing this market. Here's two: Morgan Stanley versus JP Morgan. I think they're just the two worlds right now. Morgan Stanley and Mike Wilson say this: we think the first half of this year could see beat rates fall below zero. This is on earnings. The companies with the greatest earnings risk remain those businesses that benefited from the pandemic pull forward the most. JP Morgan and Mislav Mateka say this: it's wrong to position for a recession given still extremely favorable financing conditions. We look for more gains in earnings, bottoming out in China activity, and expect the Fed not to turn ever more hawkish. Collin Martin, can I come to you on those last two lines there? A bottoming out in China activity and expecting the Fed not to turn ever more hawkish. Just whether those so-called headwinds might develop into being somewhat, at least relatively speaking, tailwinds.
They could be. When you look at China, they've eased a little bit right now. They've made a lot of headlines with the high yield real estate sector and the impacts and the spillover effects there. If there is more easing there, more government support, that could become a tailwind. The Fed, though, that's front and center. If they don't turn more hawkish, that would be a good thing for all risk assets. But going back to a lot of the points that the previous guest made, when we look at the credit markets, I think it will be there will be some more winners and losers going forward as opposed to just winners. And we look back to 2020, the Fed's credit facilities and super easy monetary policies, were the definition of a rising tide lifts all boats. And then we moved into 2021, economic growth was still very, very strong. Monetary policy was still easy and corporate profits continued to grow. It was really, really great for credit fundamentals. But now as we're in 2022, we have the Fed moving to tightening. We have supply chain bottlenecks that are still out there. They seem to be improving, but they're not gone. And that's a risk for junky, high yield companies who have very thin margins and rely on cash flows. And if there's a delay there, that's a risk. And then inflation, of course, if they can't pass on those price gains to consumers, that eats into their profit margins as well. So we are getting a little bit more cautious there. We see the greatest risk in the triple Cs, the lowest rated of the junk. They just have less wiggle room as the Fed does continue to tighten and as we do see a shift from easy to what will be described as tight financial conditions.
7 minutes into this session, equities advanced just 0.03% on the S&P. Top of the pile, consumer discretionary up 0.7%. At the bottom, energy negative a little more than 1%. We'll return to that energy story in just a moment. Tons of volatility to start the year. Let's get to Katie Lyons for more. Hey, Kaylee.
Hey, John. Well, it has been a really wild couple of weeks. I just took a look at the last 14 trading days, so about 3 trading weeks or so. The S&P 500 has moved to the up or downside by at least 1% in 8 of those, so more than half. And for the NASDAQ 100, 10 of the last 14 days have seen a move to the up or downside by 1% or more. And that is just at the closing level, John. That doesn't even go as far as to tell us about the intraday volatility we've experienced with some of the biggest intraday swings going all the way back to 2008. And the thing about it is this volatility isn't limited to penny stocks or lower valuation companies. It has hit the largest companies out there, including mega caps, Amazon and Facebook, which on back-to-back days posted the largest ever one-day market cap loss and one-day market cap gain in U.S. market history. Values literally altered by hundreds of billions of dollars. What's interesting, though, John, is amid all of this, we have actually seen equity volatility begin to retreat. The VIX, which gauges the expected swings on the S&P 500, and the VXN, which is the equivalent gauge for the NASDAQ, did reach their highest level in about a year on January 26, but things have calmed down since. What hasn't calmed down is the volatility in the bond market, with the MOVE index continuing to move higher and higher, John.
Katie Lyons, thank you very much. The volatility, a story to watch, and that story that Victoria Greene mentioned, just the divergence, the differentiation between certain sectors within the FANG trade as well. Let's get to Abby for that. Hey, Abby.
Hey, John. Yeah, this is super interesting. There's definitely a tale of 2 stories among the big mega cap tech names this year, and it shows in terms of performance. Now, back in 2020, all of these names, your Amazons, Apples, Facebooks, and so on and so forth, all higher, going the same way. But more recently, it's been Apple and Alphabet to climb higher in yellow and blue. And then, of course, you have Meta Platforms, Netflix, and Amazon going in the wrong direction. So that's a big, big divergence there. Another divergence within the FANG complex that some people may not be aware of, 20% of the New York, the NYSE FANG index, it is China tech ADR representation. You can see today Alibaba is down 5.7%, Baidu about flat. But of course, last year, China tech down in a huge way. So that's another piece of the story. But the big story relative to earnings, it's interesting, John, outside of Facebook, all of these companies have beat. Of course, Meta Platforms, they've missed in a big way. But you can see that Tesla and Meta Platforms, after the big earnings reactions, down 12%, then down 26%. Amazon, of course, into its earnings, that surprise to the upside had been down, but then a positive reaction. But big, big reactions, and there does seem to be a massive divergence within the complex, John.
Abby, just unreal. In fact, ridiculous. Can we put that graphic back up on the screen and just leave it there just for a moment, just to take it all in? And Michael Purves, I want to come to you on some of these numbers. The single-day stock market reaction of an Amazon, of a Facebook, of a Tesla, of an Alphabet, these are monster companies. And never mind the EPS beat and miss, I'd just love to see the market cap gains and losses off the back of this too. Michael, what have you taken away from these wild swings from mega cap stocks?
Well, I don't rush to come up with a sort of a fundamental narrative there. Look, I mean, if Amazon's going to be revalued higher or Facebook lower, that's sort of, sort of standard operating procedure off better or poor earnings things. I do think it's an interesting comment just on market structure and sort of the, sort of the growing use of options and the amount of options relative to cash volumes. I think there's a lot of that creates this enormous things. As your colleague was just addressing, like there's been a huge divergence in close to close volatility relative at the SPX level relative to intraday volatility in the SPX over the last 3 weeks has been at record highs, multi-year highs, much more so than the close-to-close volatility. That's really partly a reflection of this earnings price reaction, which I think is also tied to market structure issues, certainly. And let's not forget that a lot of these stocks have been such fantastic winners for so long that people, when Facebook comes in with zero growth in its core business, that's going to get a big reaction.
Information technology doing okay this morning, up 0.4%, about 12 minutes in. The S&P up 0.2%. The underperformance coming from energy. And Victoria, I promised some time with you on that, and I want to do that with you just to wrap up the conversation. Energy's down 0.6%. These stocks have been so hot. Why do you think that this run can continue?
I don't see oil prices going down anytime soon. I think we're in a period of supply and demand crunch, and I think supplies are OPEC Plus can't even meet their 400,000 barrel output because of what's happening in Libya. Maybe Iran comes on, there's tons of things, the what if game, but I honestly think the oil market's a great place to be. Number one, cyclical commodities are a fantastic way to offset inflation. Number two, a lot of these oil companies are massive cash cows. You're not seeing the old wildcatter days where they're plowing all their earnings back in and suddenly the rig count's exploding. No, it's not. The rig count's at 613. We're still well below pandemic highs and much lower than the 2014 highs. So if you look at supply and demand, you see how these companies are reacting. You have a lot of our top picks are actively saying, please, shareholders, take our cash. Devon, EOG, Conoco, you're seeing these buybacks, you're seeing the fixed plus variable dividends. They're actively pushing cash to shareholders as a reward to sticking with them through some tough times. But honestly, I think a bigger risk is energy eventually overheats. Oil over 100 a barrel is not good for the consumer. It hits at the pump too hard, and generally, it eventually will drag on the economy some. But right now, if we could sit in the 70 to 90 a barrel range, a lot of the big U.S. oil producers, especially those with a great position in the Permian, their break-evens are in the 30. So they're just printing money for us.
91 right now on WTI Brent at 92.70. Victoria, fantastic as always. Victoria Greene, Michael Purves, Collin Martin. Coming up on the show, inflation concerns looming over the Biden administration just ahead of the midterms.
Look, I'm a capitalist, but capitalism without competition is not capitalism. It's exploitation. So I'm going to continue to do everything in my power to work with the Congress to make our capitalist system work better, to provide more competition and lower prices for American consumers.
That's coming up next. This is Bloomberg.
Machine is going stronger than ever, fueling a strong recovery and opportunity for hardworking women and men all across this great country. America is back to work.
President Biden taking a victory lap. The White House economic advisor Heather Boushey saying it's up to the Fed to tackle rising cost pressures.
We did what we could on the fiscal side to make sure that we had a swift recovery, that we got jobs back, and then it is up to the Federal Reserve to use their toolbox to ensure price stability.
Out of D.C., Bloomberg's Anne-Marie. Hey, Anne-Marie.
Hey, John, we do see the administration wanting to take a little bit of a turn and repackage how they're going to communicate their economic agenda and policies to the public. So the president there was focusing on jobs after that surprise report on Friday. And we're really going to see the administration talk about wage growth, good paying union jobs, the president always likes to talk about. And thirdly, as well, the domestic manufacturing manufacturing he wants to put into the economy. We got a glimpse of it on Friday, Jonathan, when he talked about making sure they can get parents back to work, especially women, and that the government could potentially do more when it comes to childcare. But Jonathan Keeley, he did not mention Build Back Better, because members of his own party, like Senator Joe Manchin, say that legislation is dead. So it's really going to be a shift in tone to this administration. But what this administration wants to do is address parts of the economy where they think they can expand the productiveness of. Not so much leaning into what Treasury Yellen and her modern supply side theory, but for sure they are trying to find those pockets where they can make a difference in consumers' lives.
AMH, happy birthday. Down in Washington. Hey, that's the last chance I've got today.
It's getting too much
that's the
now.
Last chance
it's too
I've got.
much.
That's the last chance I've got. Anne-Marie, thank you.
I'm sure
down
you'll
in
call
DC.
me.
We appreciate it. Looking at crude, 91.15 on WTI. Brent at 92.65. We pull back a little bit. Jeff Curry of Goldman Sachs got my attention. He got your attention this morning. This is what he had to say.
I've been doing this 30 years and I've never seen markets like this. This is a molecule crisis. We're out of everything. I don't care if it's oil, gas, coal, copper, alloy, you name it, we're out of it.
Joining us now, Bloomberg's Julian Lee. Julian, what a line from Jeff Curry.
Yeah, and I've been doing this as long as Jeff has, and you really do struggle to see anything like this. The time this most reminds me of is 2007 going into 2008. We know where that ended up. It ended up with crude at just shy of $150 a barrel, followed by the most almighty crash.
Asymmetric risk, Julian, that's what I'm thinking about now. Life above 100 is difficult. Historically, it's tough. And I'm just wondering, when you get to these kind of levels, if you've got a bet on crude or on the underlying commodity producers, is it a bit toppy up here, Julian?
I'm not sure. I mean, I think if you look at the underlying fundamentals, we have relatively strong demand growth still. We're still coming out of the pandemic. There's still a lot of stimulus around. It's perhaps slowly being eased off, but there's a lot of pent-up demand there. And on the supply side, after 2 or 3 years of real underinvestment in new supply, we're seeing the OPEC plus producers beginning to bump up against capacity constraints. We're seeing slower perhaps than expected growth in some of the non-OPEC countries. Eyes are going to be back on the US shale sector without a doubt, and the growth that we see there. But you can see real fundamental tightness here.
Julian Lee of Bloomberg. Julian, great work as always, buddy. The move year to date in the energy names on the S&P, I keep going back to that sector, at more than 24% year to date. Just absolutely unreal stuff, with crude at 91 on WTI and Brent at 92.73. Let's get you some sector price action and get across to Kriti Gupta. Hey, Kriti.
Well, good morning, John. You are seeing a little bit of green on the screen, but a lot of it is isolated in big tech. It comes down to that David and Goliath story that you are going to see in markets. Consumer discretionary, information technology, essentially your big tech names leading the way higher. Towards the bottom, you have materials and utilities. Some of that movement in the tech space is also coming from a little bit of that merger Monday. Some questions about who might be a potential candidate to take over Peloton. So you are seeing some of that show up in the price action nevertheless. You are also seeing some of that merger Monday theme in the airlines as well. Frontier Group agreeing to buy Spirit Airlines for $2.9 billion in cash and stock. The deal uniting two ultra low cost carriers. Now remember, this is coming after months and months of airlines broadly being under pressure. Perhaps this is the moment for them to make a comeback, John.
Is this what Ryanair used to be? Frontier and Spirit? Is that what this is? I've never been on these planes, Kriti. Is that what they are?
A similar story, yeah, essentially.
Like Ryanair back in the day, if you're watching this from Europe, and you all remember what it was like back in the day when you had to run across the tarmac to get a seat because they weren't allocated. Good times. Equities doing okay. Bond yields coming a basis point on twos, just south of 130 on twos right now, 129. A 10-year yield, 192. Yields up a basis point. All I can think about is running across to the plane to go from East Midlands to Bergamo for £15. Coming up, your trading diary from New York City. This is Bloomberg. Five minutes in, Nasdaq coming back up 0.9%. Let's call it 1% higher on the S&P, up a third. The small caps, the Russell doing okay, up 0.9%. In the bond market, we settle down this time in and around 130 on twos. Right now coming in a basis point to 129.64. Looking at the Italian bond market, we back away from the session highs too. Guy Johnson and Katie Lyons will run you through that in just a moment. That's the price action. Here's the trading diary. Looking like this for President Biden, meeting with the German leader, 1:30 Eastern time. Trade balance numbers coming on Tuesday, wholesale inventories on Wednesday, plus Fed Governor Bowman and Cleveland Fed President Loretta Mester speaking later in the day. Then US CPI, the big one for this week, with initial jobless claims on Thursday, plus tech earnings. Continue with Twitter on deck, and rounding out the week with the University of Michigan Consumer Sentiment Survey. From New York City, welcome back to a brand new trading week. Thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.